I am here with Larry Fink, the CEO and chairman of BlackRock. We're at the BlackRock annual fixed income ETF conference here in Midtown Manhattan. Larry, good to see you.
Hi, Eric.
The world has its share of problems. We know that, not the least of which, of course, is the horrible massacre in Las Vegas. There's the natural disaster in Puerto Rico, and the reconstruction efforts that are just beginning there. But if we take a step back and look at the big picture in economic and financial terms, things look pretty good. Right, the S&P 500 is trading at 25.30 this morning. The 10-year yield is at 2.35. The VIX is still under 10. My question to you is this. For how much longer can this Goldilocks state of affairs persist?
Well, first of all, Eric, I agree with you. We should pause and think about these natural disasters and the tragedy in Las Vegas. All of this reminds you how tender life is, and we all have to respect that. And remember our loved ones and our friends all the time.
It's true.
And you forgot about Tom Petty, too. I mean, I'm not sure if it's a Goldilocks market. I actually believe, to my surprise, and I think to many people's surprise, how resilient the world has become. You have China that's growing close to 7%. You actually had surveys that just came out yesterday of China possibly even accelerating. You had a 5% increase in the Chinese bank stocks today, or in Hong Kong, not because China's closed, but you have a Japan that we witnessed for 20 years, stagnation, and we're seeing last quarter growing at 4%. Let's presume now Japan is growing at 2.5%. You have a Europe that we were all frightened of. We did not believe the outcomes of Europe to be so significant positively. Now, obviously, you had the Catalonia, you had some issues in Spain, but overall, you've had a very aggressive monetary policy by the ECB. You have more talk of political union with Macron and Merkel. You have a banking community that's well capitalized finally after 9 years. And you now are witnessing 2.5% growth in Europe. And then we have the United States, despite whether you are very pro what's happening with Washington or negative, the real economy is doing quite well. The American consumer is feeling good. We have, low 4% unemployment. We're seeing wages going up modestly.
What does it all mean? What does that resiliency, to use your term, mean? Should investors feel more comfortable taking risk than they might have, say, 6 months ago or a year ago?
There's certainly more information that's more positive, and I think the market's reflecting that. And I do believe the markets overseas represent probably more value than the United States. They certainly are trading at lower PEs. The opportunity there is probably greater. We as the largest nation in the world, and economic force, we actually have more uncertainty than other places in the world right now. Are we going to have successful tax reform? And how is that going to all play out? And we'll know that in the next 2 to 6 months.
Since you brought up the topic.
Let me just finish one last thing, excuse me. I think we're going to have to see corporate earnings in the next few weeks. In the second quarter, corporate earnings were quite strong. And from what we are hearing, corporate earnings are going to be fine in the third quarter. So you're seeing all the different points that lead you to believe that the markets are fine. And I wouldn't call it Goldilocks. The markets are fine and are going to do fine between now and year end.
Even though we've already seen, say, U.S. stocks advance.
Up 12-ish%.
Yeah, 12+% this year. Yeah. They have more room to run.
Less than international stocks. So Europe is run maybe on a currency-adjusted basis 10-ish%. Asia 10-ish%. So we've outrun, in the last 3-4 years, we've run much faster than some of the other places in the world in terms of stocks. We are at record highs. Europe is still not even close to record highs. And obviously Japan is, 50% away from its record high, not that quite, but probably 40% away from its record high. So you have other areas of the world that represent probably more value going forward.
As you pointed out, Larry, there is some uncertainty here.
Yeah.
some changes that the Trump administration wants to make that will have an impact for sure, right, on the pace and character of the economy. Tax reform is one of those things. What do you think of the tax reform proposal as it stands now?
I think it's going to have to be amended, and it has to be amended quite importantly. I'm not a big believer in the reduction or the elimination of deductibility of state and local taxes. I think that that's quite harmful to some of the major states today. As you know,
including this one right here.
Including New York and New Jersey. I actually believe one of the greatest problems in the world we have today, especially in this country, is the lack of saving for retirement and the liabilities of some of these major states in terms of retirement. If we stretch the states economically through the elimination of deductibility and people move, I just think it creates bad behaviors within our own country. But getting back to the specifics, there are a lot of merits in what was being proposed, but let's be clear. What is being proposed is a pretty large expansion in our deficits. According to the CBO, our deficits are going to grow to $25 trillion in the next 10 years before whatever this tax reform is or tax cut is. So whether this tax reform or adds another $1.5 trillion, another $5 trillion, we can all debate, and we all have our own scoring. But my biggest worry out 10-ish years with a country that is so dependent on foreign ownership of our debt. We have the Chinese and the Japanese owning as much as 25 to 30% of our U.S. Treasury debt. And if you look at demographically, the domestic needs of China and Japan, they're going to need a lot of that money. And to think that we could have foreign ownership of 30-odd% out 10 years is probably a bad assumption. And so my worry is, are we growing our deficits in front of some very big demographic walls?
Well, we are, and we have been. Are you saying that
it works if we can successfully bring our economy up from this 2 to 2.5% range to 3 to 3.5%. We have to grow out of that.
That's what the president says he wants to do. That's what Gary Cohn says this tax reform proposal is designed to do.
That happened with the tax reform during the Reagan administration. It hasn't happened ever since. It brings growth forward and it decays forward in the future.
So are you saying that the tax reform proposal needs to be budget neutral?
No, but it has to be mindful of what we need to do related to our deficits.
So what would you change?
Well, I'm not a tax expert, and you're asking me many tax expert questions. But let me, I don't believe we're going to get tax reform if there is the elimination of deductibility of state and local taxes. Obviously, that creates a bigger deficit. So we're going to have to find it somewhere else. Obviously, one of the ways of doing it is by raising corporate tax rates from a proposed 20% to something close to 25 or 27. That's still a net positive versus what we pay today. And I think by and large, most investors, most corporations would welcome that. Two.
You'd be fine with that?
We'd be fine with that. We pay about a 31% tax rate worldwide, so it's fine for us. Two, we need to make sure that we're fair and just across all the different sectors. I do believe what the president's tax proposal, their proposal related to partnerships, that will help the small and medium businesses quite a bit by having that 25% tax rate.
There's also change coming at the Fed. Whether or not Janet Yellen is replaced as chair of the Federal Reserve, there are a lot of vacancies that the Trump administration needs to fill. We know, of course, that Randall Quarles has made it through committee. He's probably going to get to the Fed. Yes. Stan Fisher is leaving the Fed in less than 2 weeks. How, Larry, will a more Republican, let's call it that in quotation marks, a more Republican Fed change monetary policy? What will it be like?
Well, I don't ascribe any political party to the Fed. I think the Fed, and I think the members of the Federal Reserve believe that they have to be independent. So I don't believe you're going to see any real change. Historically, you would say Republican-oriented or fiscal conservatives would be much more hawkish. We have a Fed that has historically been more dovish and I actually believe if you think about all the named potential candidates to be a potential replacement for Chairwoman Yellen, or it may still be her, I would say they are more moderate.
Whether it's Jay Powell, whether it's Gary Cohn, whether it's Kevin Warsh?
I would say they're going to be more moderate than what I would think historically a candidate from a Republican president be. Mind you, Ben Bernanke was selected by a Republican, and he turned out to be, I would say, fiscally prudent, but he was also very aggressive in terms of the problems we had during the crisis.
So how do I interpret what you say? Are you saying that you don't think the Fed's going to be too much different regardless of...
Exactly. You said it.
Really?
Yeah, I actually believe a successful Fed is a Federal Reserve that we don't have to talk about that often. A Fed obviously played a major role in the 08, 09, 10, 11. But if we have a normalized economy, I think we're going to go back to not having that deliberate worry about the Federal Reserve as much.
I think that's part of the conversation.
It should be. I think the Federal Reserve played a significant role in stabilizing our economy. But if we have a normalized economy, I think the debate, the conversation we have about what the Fed's going to do is less important. It's going to be much more important about how are we driving innovation, how are we driving jobs in our economy.
Larry, I want to ask you a question about the relationship between the buy side and the sell side, and it has to do with MiFID II, this new set of financial regulations that's being adopted by the Europeans. It's the source, as you know, of a lot of anxiety on Wall Street. How are you thinking about it?
Well, I'm not anxious. I have no anxiety.
But you're also the guy who says he's not on Wall Street anymore.
Well, but I'm just saying we're not. We look at it as a net positive. MiFID II is creating more transparency. We need more transparency.
By unbundling the commissions.
Correct. The biggest problem we have in the world today is this fear of retirement, the inability of having proper savings. In Europe, in Germany, over 72% of all individual savings still is in a bank account. That is true in other parts of the world. In Japan, there's $5 trillion of individual savings in a bank account earning negative return. I think much of it has to do with the investors didn't feel comfortable in understanding how this investment will help them over the long term, and they had fear of all the commissions and prices.
So transparency gives them confidence.
Transparency gives them confidence, and I actually believe one of the strong reasons why we've seen accelerated growth in ETFs is ETFs have much more transparency than other products. So I actually think the movement towards greater transparency, whether it moves how people are getting paid, which that was your source of your question, but I do believe the net result will be greater confidence by our clients, or the people we're trying to help towards retirement, and if they invest more and put less of that money in a bank account and more into long-term saving, that may drive greater global growth. I actually believe with the amount of cash that's sitting in the sideline is one of the reasons why global growth has been so anemic.
Do you expect BlackRock will spend more or less on research as a result?
We intend to have just as much research internally. We're going to do it more efficiently. We're going to be having much more systematic teams looking at
No, I'm talking about the research you buy.
Oh, it's going to be a fraction of, it's going to be much more internal.
Really?
Yeah. We are going to have our own, we already have many researchers.
Of course.
It's going to be much more heavily designed to fit our needs. It'll be more customized to fit our needs.
Partly as a result of MiFID II.
I actually think it's going to force better behaviors by BlackRock and other organizations to systematically build a better proprietary research platform that hopefully differentiates and creates better active returns.
What you just said, though, ought to terrify every large research-producing bank on the street. That BlackRock is going to spend a fraction of what it does now on research, external research going forward.
External research. I said I have no anxiety.
Do you have any idea how much you spend now?
I do, but I'm not going to talk about it.
Larry, you know Howard Marks of Oak Tree Capital. And Howard, as you know, is a big fan of cycles. A couple of months ago in August, he put out a memo itemizing a long list of things that he thought might lead to a bubble. Everything from the FANGs, for example, to low volatility. The list goes on and on. He also added ETFs to that list, and I have an idea as to what you might think of that criticism. But he pointed to one thing that I hear more and more about: Bitcoin and cryptocurrency. Have you developed a view on Bitcoin and cryptocurrencies? And what is BlackRock doing about them?
Well, I believe in blockchains. We're looking at many blockchains. We created provider Aladdin, which is really a blockchain between us and the clients.
But that's the underlying technology.
But it's a private blockchain, okay? But we believe if we can create more and more flow-through information by having all the different reference points of a transaction being systematized, that's good. Related to cryptocurrencies, I'm a big believer in the potential of what a cryptocurrency can do. You see huge opportunities in it, but what we're talking about today, it's really much more of a speculative. People are speculating on it, but most importantly, what I think about most of these cryptocurrencies, it just identifies how much money laundering there is being done in the world, how much people are trying to move currencies from one place to another. So I actually believe you're seeing the demand for it, but let's be clear, if we created a true global digital currency, I hate the word crypto, a digitized currency, then then you would not have money laundering anymore. You would have everything understood, everything would be flowing through, everything would be identified. You could see all the application, except I'm horrified on one point: how do we preserve the system from cyber problems? Because if the whole world is using this one network for financial transactions, it presents a lot of systemic risk.
Is it time yet for BlackRock to either trade in digital assets or digital virtual currencies, if you prefer, or to create a product for your clients?
We're not hearing any demand from any of our clients, other than maybe some speculative stuff. We're being asked that question, but it's more of like a venture capital type of interchange, but we're not hearing clients saying we want to use this as an asset class. No.
It's not an institutional thing yet.
It's far from that. As I said, it's much more of a speculative platform for Asia, and it's heavily used for money laundering.
Larry, we're here at a fixed income ETF conference. Share with me where you think the bond market is going to be 5 years from now.
Well, for someone who's been in the bond market now 41 years, the bond market has evolved and changed, and it's continuing to evolve and change. One of the fundamental problems of the management of bonds are still incredibly cumbersome. If you own all the bonds in the Bloomberg index, I think it's over 3,000 individual bonds, and it's a operational headache. And so we believe as we create more and more efficiencies, you're going to see different techniques that are being used in the management of bonds. We're a big believer that ETFs will play a bigger and bigger role in bonds, because you could basically own 4 ETFs and have the majority of all the exposures that you have in bonds. You could own an ETF that has convexity, a mortgage bond. You could own an ETF that has domestic credit.
So let's put a number on it. Right now, passives account for 1% of the global bond market. 5 years from now, it's what?
15.
15% from one today.
Yeah.